In this video, we look at the drivers of the recent rebound in the share price of Osisko Development. Canadian Mining Report is not a financial advisor. This video is for informational purposes only and does not constitute investment advice. Osisko Development is one of the three largest gold stocks on the TSXV at a market cap of around 600 million Canadian dollars, along with Newfound Gold and Artemis Gold with market caps just over $900 million. However, it's had by far the weakest performance of these three since 2021, as the gold price boom of 2019 and 2020 faded, with only gold juniors with truly outstanding company-specific drivers seeing much support for their share prices over the past 2 years, with the gold price relatively flat. The exploration stage Newfound Gold has had such drivers in the form of extremely high-grade drill results from its Queensway project, driving its share price up over 200% by mid-2021, but even it has succumbed to the equity market pressure, which has especially hit small caps, with its gains since 2021 sliding to 51% currently, although this was still far ahead of the TSXV Metals and Mining Index up just 9%. The second largest player, Artemis Gold, is down 24% since 2021, even with very clear progress on its large and advanced Blackwater project, which is nearing production, while Osisko Development has been the laggard of the three, down 67%. However, there's been a strong turnaround in the share price of Osisko Development in the market rebound of the past 4 months, with the share price gaining 25%, over double the 11% gain in the TSXV Metals and Mining Index, and well above an 8% increase in Artemis and 4% gain for Newfound Gold. This has been driven by major operational announcements in January 2023, surprising a market that until recently had been clearly pricing in a quite bearish scenario for the company relative to other TSXV big gold stocks. The biggest announcement has been the completion of its feasibility study for Caribou in British Columbia, which is its largest project by far, with total resources of 5.3 million ounces of gold, and the study indicating an after-tax project value of 504 million Canadian dollars. It also announced a mineral resource estimate last month for the Trixie mine in Utah, part of the Tintech project which it acquired in 2002, which, while only having resources of about 500,000 ounces of gold, is extremely high grade. The company's third project, San Antonio in Mexico, has 1.1 million ounces of gold resources, but at a much lower grade than the other projects. The company has actually had small-scale production from all three projects in recent quarters, including from the Bonanza deposit of Caribou, although this resource has already been fully depleted, and it has ongoing production from Trixie, which had been producing before Osisko's acquisition of it, and it's processing a stockpile from San Antonio. However, the big value driver remains Caribou, with commercial production expected by 2024, with further potential upside from expanding at Trixie. We look here at some of the scenarios of what the market might be pricing in for Osisko Development, with a starting point of the current market cap of 593 million Canadian dollars in each case. In the first scenario, we assume the market is pricing in the full 504 million Canadian dollar value for the Caribou project, which implies a market cap to resource valuation of $95 per ounce, with $65 per ounce for Trixie and San Antonio combined. However, it's unlikely the market is pricing in the full value for Caribou, given the risk that there is in still getting to production. So in the second scenario, we discount Caribou to 90% of its value, which implies a market cap to resource of $85 for Caribou and $102 for Trixie and San Antonio. To determine what's a reasonable relative valuation at this point, we have to consider both the relative grade and risk of the projects. So Caribou's average grade is 3.5 grams per ton, which is over 3 times the 1.1 gram per ton grade of San Antonio, but Trixie's grade is far higher at 23.2 grams per ton. And as we're combining Trixie and San Antonio in our analysis here, the average grade is 5.5 grams per ton. So with Trixie having the very high grade and with it already in production, the market could be attributing a higher value to the resource than Caribou. But this will be offset to some degree by the much lower grade of San Antonio and its lack of medium-term output beyond the current stockpile, with the project not having reached the PEA stage. In the third scenario, we discount the feasibility study value of Caribou by 70%, leading to a market cap to resource of just $66 per ounce and implying a $175 per ounce valuation for Trixie and San Antonio combined, which would be almost 3 times the level of Caribou and well over twice the average $75 per ounce for a group of comparable junior gold developers, which suggests that this number could be a bit excessive. The market's valuation likely therefore lies somewhere between the first scenario, which perhaps overstates the market cap per ounce valuation of caribou, and the third scenario, which may understate it. For more information on junior gold and other metal miners, click the link in the description or bio below to go to www.canadianminingreport.com.